everybody. It's Mike Preston at New Harbor Financial Group. It's Wednesday, October 25th, and just wanted to give you a brief update to tell you a little bit about what we're thinking, what we're doing, a couple little changes that we made over the last week. I've got a couple charts to share that I'm going to bring up onto the screen now, and we'll go through them. The first one I want to show is, well, actually the first couple charts are about the housing market. The housing market has been remarkably resilient over the last, over the last 6 to 12 months, certainly really since the blow off top in real estate in 2021. The housing market has just not shown signs of slowing down. And the thinking the whole time was that, well, you can get a mortgage at 2 or 3%. Why wouldn't you be able to buy a much bigger house and much more house? Well, take a look at this chart here. This is the average versus effective 30-year mortgage rate. This is not even updated as of the last couple of months because lately mortgage rates are right around 8.5%. This is a huge difference from what we saw over the last few years because of the bubble that we've been living through. Really, the Fed buying bonds, pushing rates down to zero after the 2008-2009 housing crisis. Mortgage rates stayed down in this 3% range. We've just seen the largest jump in a short period of time that we've really ever seen, maybe short of this time back here in 1975, but certainly the biggest jump that we've seen in decades. And so it's kind of puzzling, right? If the argument was that with low rates, you can afford to buy a much bigger house, why aren't people more reluctant then to buy more house? Why aren't they demanding lower prices for real estate when mortgage rates are up at 8.5%? Well, it's pretty interesting. And I think that that's about to change pretty soon. But right now, mortgage rates are over 8%, and new home sales are still strong. Prices are still strong in most areas outside of bubble regions. The average mortgage rate, that's the white line here, is still down around 3.6% because most people are locked in at low rates and now they can't move. And so rates have shot up here, and it's only the marginal buyer that's buying homes right now. And they're buying from only one specific place for the most part. I'll tell you about that in a minute. But the housing market has remained remarkably resilient, and it's likely to change. But it's interesting, down here at 3.6% or so, with rates up at 8.5-ish, it's going to take some time for that average mortgage rate to come up, and it's going to happen. It's only a matter of time. Take a look here at the next slide. This slide shows the U.S. home sales versus mortgage interest rates. I know this chart is only a couple of years old, but it's been remarkable that since September of last year, the last 12 months or so, the home sales have continued to be strong, even while interest rates have gone up. This is the red line is the 30-year fixed mortgage rate inverted. And so if you look over here, you'll see that we're down around 8.04% on the 30-year mortgage, and yet home sales have stayed really strong. This is one of the biggest gaps we've seen in a long time. This is going to change. At some point, something's got to give. Mortgage rates come down or home prices come down. This is a gap that will not stand. It will end up closing at some point. This is the average rent payment in the United States versus the average mortgage payment. Take a look at the total and monthly payment for mortgages. This is the darker line versus the rent, the lighter line. The average rent has been going up for the last decade. That makes sense. The average mortgage payment is relatively in a range between $1,500 and $2,000. But look what happened over the last year. We went from $2,000 straight up over $3,000 on new mortgage payment, while the rent payment has stayed relatively stable. It is also trending up. But the point is that this gap never ceases to close. It always closes. And this is not sustainable, that the prices of homes are going to stay this high or that mortgage rates are going to stay this high. Something's going to change. And usually what changes is the monthly payment on mortgages goes down. How does that happen? Well, it's really only one of two ways. The price of homes falls or interest rates crash. Our bet is on the former, that the price of homes are going to come down. Now, I don't think that homes are going to crash the same way that I think the stock market could likely crash. The stock market could easily be 60 to 70% below here and still not be undervalued. The housing market is likely to see a correction, though. And if I had to guess, I'd say it'd be more on the order of 30% or so. I want to turn the attention to the stock market now, and I'll show some charts on the stock market in just a moment. This stock market this year has been a very concentrated stock market, really for the last couple of years. The top 10 names in the entire S&P 500 account for about a third of the entire index. The S&P 500 is a cap-weighted index, meaning the market capitalization, the value of the whole company. Top 10 names is about roughly a third. That is historically aberrant. Take a look back at what happened at the peak of the tech bubble. We're up to around 29%. Most of you probably remember the dot-com era and how it was just a handful of internet stocks that were pushing the market up into its final bubble top. Well, here, we have achieved an even higher level, and this has kind of been the same way for the last few years. Take a look at the top 10 stocks, what they are. Take a look at these names. These are household names. And the top 7 stocks, the Fantastic 7, so to speak, are 27% of the index. Take a look at what they are. Tech, 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 tech. All technology. A very thin market. If it weren't for these 7 stocks, the market would be down. Take a look at the other 3. Well, there's 2 in there that are not tech stocks, but Tesla is, I guess, a car company, but a lot of people look at it as a technology company as well. So let's take a look at some charts of the market here. This is the S&P 500. And one thing I want to point out is the market, the S&P 500 actually topped a year ago, almost 2 years ago now, January 4th of 2022. The bounce from October has been very persistent, but this swing high happened on July 24th, 3 months ago. This is what bear markets do. They lull you to sleep. We're still amongst the highest valuations in history. We've been talking about this head and shoulders top potential here, but it's been a very, very controlled decline. There's been very little panic at all. We do have a close here well below the neckline. So we should see 4,100 pretty quickly, in my opinion, and then perhaps lower. That could give a short-term opportunity. But really, the risk is to the downside. Look at what the S&P has done year to date. This dotted line is the beginning of the year. So the S&P is still up about 8% or so. But take a look at the equal weighted S&P. I'm going to pull up that chart here. The equal weighted S&P 500 is down on the year. It's down a good 4%. So this is, if you take all 500 S&P stocks and weight them equally, the market's down. In fact, the market, is back to where it was a couple of years ago. That's not what you'd think on the surface. I think a lot of people think, oh, the market's going up, I've got to be in the market. But really, if you're not in those 7 stocks, you're down. Take a look at the Russell 2000. The Russell 2000 is the 2000 small and mid cap stocks. The Russell 2000 index is actually down on the year as well. In fact, it's getting darn close to undercutting the 2022 low. So the mid caps are leading the market down. The equal weighted is down on the year, and the S&P 500 is up about 8% only because of the tech stocks that are in it in the NASDAQ. Take a look at the NASDAQ. The NASDAQ is dominated by those 7 names that I just showed you. It's still up 30-something%. But in my opinion, all indexes here are tracing out tops, and the risk is definitely to the downside. I want to talk about bonds here because early in this update, we talked about mortgage rates, interest rates. That's all happening because of the meltdown in the bond market. This is a monthly chart of TLT, which is long-term bonds. This drop in long-term bonds is really bigger than the stock market drop in 2008, 2009. And it's our opinion that this meltdown is the biggest story that not many people are talking about. This is what's driving mortgage rates above 8%. This is what's impacting companies' ability to refinance debt and roll out debt. And indeed, it's what's going to start affecting the government's ability to continue with the debt that we've got now. We're at 33 trillion on the national debt. It's increasing at 2 trillion plus per year. This is up from 8 trillion in 2008. Interest payments on that debt are already around 40% of total tax receipts. Now, I think that this bond market meltdown is a huge warning for the housing market, huge omen, I should say, for the housing market and the very overvalued stock market. I believe that this is overdone. The Fed has been very adamant about saying that they're going to break the back of inflation. I actually think that the sell-off in long-term bonds is an opportunity. We do have a position here, as many of you know. It's not a big position. It's only, it was only about 15% max per account. It's been hedged many times. We have continued hedges on TLT at 85. We have puts that are in the money. So most people only have about a 6% or so, maybe 6.5% net exposure here. And we continue to pull more income in on this position by selling calls against it. So I actually we believe that rates will go back down and that bonds will go back up. TLT should see, in my opinion, maybe 120 to 140 in the year ahead, maybe 2 years ahead, as it's inevitable. I mean, the Fed and other central banks are going to have to act. They have no plan B. They're going to buy long-term bonds again. The yield curve is going to uninvert. Short-term rates will probably fall. And the opportunity is in long-term bonds. Having said that, we're not taking a big risk there. Like I told you, it's only about a net 6% or so, 6.5% exposure. I'd like to talk about gold here briefly. Gold still looks the best of anything out there. This is the 20-year chart. We had a big reversal month over the last month. We're knocking on the door of $2,000 an ounce. I think it's only a matter of time before we clear this triple top and gold moves higher. Gold should move towards about 2,500 in the next year. That will almost certainly pull up gold stocks, which have been underperforming. This is GDX. GDX has been trading in this long range here. I believe GDX will go up to maybe 45 to 55 if I'm right about gold going towards 2,500. We're still about 50% in cash equivalents right now. We're very, very picky about exposure. We do have some exposure in emerging markets, about 15%, and industrials, about 5%. That's a total of about 20% in stocks. But we have a 15% position in the money put options on the S&P. And that put option is a December put option up at 450. So the way to describe this is it's a 15% notional position, roughly, of the size of your account in the money put options. And that means if the S&P drops, that position will go up, equivalent to what you would expect if you were 15% negative the S&P in your account. That offsets almost all of the stock exposure that we have in the 15% emerging markets and the 5% industrials. I can't say that we're definitely not net short. I can't say that there's no risk, but we have hedged out almost all of the risk in the account. The short-term fluctuations that I'm sure that many of you see and some have asked about, that we have a couple percent fluctuations. Unfortunately, in the last few weeks, negative fluctuations have been because of TLT and a little bit GDX, although GDX or gold miners has bounced pretty smartly. We're constantly looking for new ideas to put money to work. The problem is that our indicators are very strongly on defense at the moment. We're not going to take any new ideas unless they're well hedged and uncorrelated with the general stock market. One bull market that we have noticed is in uranium and uranium mining type names. Take a look at uranium here. Let me go to a different chart. This is an ETF that holds the element uranium. It's been on a stealth bear market the last few months. This is a daily chart. Take a look at a weekly chart. It just basically broke out of a base and it's doing well. It came up on our screens. It fits into our thematics about alternative energy, commodities, and things that are non-correlated with the general stock market. We decided to take a very small hedge position in an ETF that owns uranium and nuclear plays. This is URA. We just bought this the other day at 25 and change. We sold a December 26 call option against it, which does cap our upside, but gives us a really good risk return. So this is a 5% position in URA. which technically does increase our stock exposure that I mentioned earlier, up to around 25% if you want to include this, but it's not very, very correlated with the S&P. As you can see, it's been going up as the S&P has been going down over the last couple months. But again, we're still 45% or so in cash, and I'm going to stop this chart. Looking for more ideas, our best guess is that we get a washout in the market, a continuation down in this head and shoulders breakdown, and we'll start layering into the market with hedges, but we won't really take any new bites until we see a bit of a washout, some kind of elevator drop. I think that could get us at least a 3,800 on the S&P, which would be another almost 10% down from here. The problem is that the market could easily fall another 50% from there and should. So you have to have a plan on how to get in. Our plan is to layer in a very measured manner with hedges, selling call options against positions. This way, hopefully we can make a little bit of money on the way down. That is, if the bottom doesn't completely fall out. But it's all about timing. It's all about using tools like options and about being patient. I know it's been a difficult couple of years. It sure has been frustrating for us that this stock market has refused to go down, even when it's trading statistically at levels that we know it can't stay at forever. But so far it has. Happy to have this update with you this week. I look forward to seeing you again next week. Thanks for tuning in, and thanks for your patience and your trust. We really appreciate it. And until next time, thank you very much from New Harbor.